Good morning, folks, and welcome back to Almus Market Mornings. Every time I prepare for this podcast, the Monday episode seems eerily similar. As usual, there's no development on the Iran US conflict, and there's always reflected in higher oil prices and yields. The yields, especially, are quite the point of concern right now. Friday saw a bond sell off getting accelerated. Just for context, since the Iran war started at the end of February, US 10-year yield is higher by 66 basis points, Europe higher by 54, Japan higher by 67, and UK is higher by almost 87 basis points. Apart from this, today morning we once again are seeing oil prices sharply higher. Gold prices have seen a sharp sell-off, and dollar is generally stronger, though dollar index is in a range. Friday also saw rupee hit fresh lows, breaching the psychological mark of rupees 96. Good morning, JK. What are we looking at? Because things don't seem to be really improving. What's your reading of the situation?
Good morning, Swaraj. Yeah, what you say about Monday mornings is definitely true. Except that now we are more concerned about the market turbulence while the war situation remains in an impasse. So I think we know focus is on how the bond market turbulence is started to impact everything. Of course, this is also originating from war itself. So let's look at the war situation itself. The conflict as now standing in a big standoff where neither side can actually back down without appearing weak or suffering strategic losses. So now, demands from Iran are largely unacceptable to US and Israel, while prolonged war is imposing severe economic costs on both Iran and the global economy. We know that the rising oil, gas, and fertilizer prices are fueling inflation and pushing global bond yields also higher, creating risks for debt-heavy economies like US, UK, and Japan. So, despite heavy sanctions and economic pain, Iran appears to be willing to endure the prolonged hardship, whereas the rest of the world is actually suffering, and that's where we are. And likely to be there for some time because while negotiated compromise remains the most likely outcome, the standoff can persist for much longer and continue to weigh on the global markets growth. So take it as a given that the war related tensions are set to continue or the war situation is not likely to improve, and the reactions in the other markets are going to be even worse going forward. Now, as we enter this Monday morning trade, I also wonder whether the bond market crisis, which we have been hinting at for quite some time, is finally here. We know that the major developed nations like US, Japan, and UK already are carrying historically high debt and fiscal deficits, and they have managed it mainly due to low inflation and stable bond yields. But the surge in oil and energy prices following the war has reignited the inflation pressures globally, and that has led markets to increasingly price in rate hikes now instead of rate cuts thought of a couple of months back. So the yields have consequently risen sharply across major economies, reflecting investor concerns over inflation, fiscal sustainability, and rising defense spending as well, which is adding to the problem. Now, persistently higher yields and significant increase in government and corporate borrowing costs, especially in US, which already has a 39 trillion of debt, while also creating risk for banking systems, sovereign credit quality, and good quality conditions. Eventually, all this, when governments or the central banks try to address the inflation through rate hikes or some other measures, they can be even they can trigger a global recession also. So there is a lot of implications that we should be looking ahead to with this global bond crisis. And in this context, the UK's political problems could not have arisen at worst time because yields in UK at a multi-decade high is adding to the pressure. Now, what the governments can do, of course, is they can. This is a huge elephant which is on the move. That's the bond market. It takes a long time to move like this, and when it moves, it's very difficult to counter it. So the bond prices could fall for. Sorry, bond prices could fall further, and yields can rise further. And that can happen even without market shorting the bonds. It is simply enough if there is no demand or fresh buying is not there. So this is because governments are constantly borrowing to fund their unsustainable debt. So demand being high, and demand for the demand for rather the supply of bonds being high and demand being low, that itself is enough to push the bond yields higher. What can the government, which is the biggest stakeholder in the bond market, is likely to do is to uh, possibly pull out some of the tools, like yield curve control or bond buying by the central bank to start with, and maybe going forward, some sort of a QE also can be announced if things get out of control. But none of this is going to address the inflation, because if they continue, if they resort to QE, more money supply and inflation will be even higher. But they have to choose between controlling the bond yields, which is directly impacting their fiscal and interest costs, or address the inflation. So this is the big choice, big difficult choice in the government's domain now. In the meantime, until something is done, yields will go up. There will be pressure on stocks. Dollar will remain strong. EMs will be, of course, under more pressure because money moves from EMs to US because of the higher yield attraction. Gold, silver can fall further as well. And commodities, which have had a big run, can also see some decent correction. So the global market turbulence perhaps is set to be here for some time, and we look ahead to what the governments or the central banks do. Particularly the actions from Japan and US will be very closely watched, because if any actions which is initiated by them is likely to lead to some sort of a reaction from the other markets as well. As far as India is concerned, you already mentioned that the rupee hit a new low on Friday at 96.13, but closed below it, mainly due to intervention. But the government's efforts on suppressing the rupee's fall is also continuing, because there is a notification that the silver bar imports, and in the category of 99.9% purity, have been brought under restricted category, and there is no free import that is allowed now. How much effect it will have on the actual usage and also on the investment demand is something that we need to wait and see. But for me, while if see, we import almost last year we imported more than 10 to 12 billion equivalent of silver. Now, whether these measures reduce the imports, which has a high industrial demand as well as investment demand, is something that we need to wait and see. But for me, what it all indicates is that governments and RBI's keenness to slowly introduce more and more measures, and some sort of restraint on market getting too ahead of itself with speculation on the USD INR. And as I've already said, I think these will have some cumulative impact eventually, although immediate dramatic impact or turnaround in the rupee is not likely. So we'll see rupee also under a bit of pressure as bond yields across the globe rise, and the Indian yields are also likely to rise. Except that, only one silver lining perhaps is that the FI selling in Indian stocks perhaps has less intensity is seen now. This could have several reasons, because the other markets where they were investing, moving away from India, they have seen a very big move, and there could be some rerouting of those monies into some of the undervalued packets in India. And perhaps, as I already shared earlier, if Indian yields go towards 7.2 or earlier, or sorry, higher, as we have seen in the past, there could be some good demand. And now that even government is considering some sort of a tax break, or so not tax break, but some tax reduction for these investments. If those decisions do come, the timing of that is very important, because if the global tensions continue and we introduce such similar reforms, it might well fail as well. So look forward to more changes in the Indian context, but no immediate impact. But overall, concerns of the government and RBI are likely to keep the pressure on the rupee somewhat contained, not really stopped. Thank you.
Thank you, JK. And yes, so we will be looking at how the bond markets are moving. Yields everywhere are moving higher, and that's a cause of concern for the high debt economies. That would investors would start having fiscal concerns, and that can impact the broader financial markets. So that's what the theme would be for this week. Apart from that, domestically, of course, we are seeing rupee hit a new low at 96.13. Government is trying efforts to curb the depreciation. They have recently put silver bar imports into the restricted category. But as the global wave of bond yields rising continue, maybe the pressure on rupee will persist. That is till the time there are some structural policy changes that come into place. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.